Right, good afternoon everyone. Today we're going to look at the difference between insurable and non-insurable risks. What is the major difference between them and what are the examples? So an insurable risk is a risk that is insured by an insurance company. Insurance companies decide on the likelihood of an event taking place, and then they decide if they want to insure that risk and they charge a premium for it. Whereas with the non-insurable risks, these risks are not insured by insurance companies, as the cost or the risk is just too high, and so it remains the responsibility of the business or the individual. You see, the insurance company cannot calculate the profitability of the risk, and they cannot work out a premium that the business must pay. So on the one hand, a premium can be worked out, and on the other hand, it's too difficult to calculate what that premium would be. Some examples of insurable risks include theft, if someone steals your hockey stick. Fidelity insurance, this is for dishonest employees that you employ. So let's say you have a cashier, alright, and they steal cash from your till. You have something called fidelity insurance. It's against dishonest employees. A burglary, or when you have money that you're carrying with you and it gets stolen out of your handbag, that is called money in transit. A fire is another example of an insurable risk. We also have natural disasters such as floods and hailstorms, and one can claim for the damage that this causes to your property, such as a car. And then vehicle insurance, let's say you're hijacked and your car is stolen. All of those kind of insurances can be calculated and a premium can be worked out. Non-insurable risks, however, on the other hand, are a little bit more tricky. Here we're looking at things such as nuclear war, changes in fashion, improvement or changes in technology. The fact that iPhone 10 is now out and you've got an iPhone 6, there's no insurance that can pay you out for that improvement in technology. If you can't get your debts back, so irrecoverable debts from your debtors, financial loss due to bad management, possible failure of a business, shoplifting during business hours, loss of income if stock is not received on time, all of these things cannot be calculated and the risk is just too high for insurance companies to take. I hope that makes sense.